Episode 24, pulling back the curtain. I convinced my colleague Adam Gelhausen to be here with me. He is not happy about it.
He's duped.
He's duped. Didn't know podcasts were audio and video. So, but we'll keep this easy. So I know we had you and Dave on, just some kind of intros. For everybody listening, a little bit different. We obviously have been interviewing a lot of entrepreneurs and people in the community with what's been going on, not just here in the last month of August, which was a turbulent time, obviously heading into fall, which has been seasonally a tough time for markets, but it's been a weird 2 years, 10 years, pick your time frame. There's been a lot of, this hasn't happened before is going on. So I thought it'd be a good time to stop, pause, talk a little bit about where things are at. And again, not so much to try to predict where they're going to go, because that's not something we try to hang our hat on, is predicting the future, so much as really talking about the philosophies that govern our processes individually and collectively, as well as share some maybe insights around the markets that people may not be aware of and concepts that they hadn't really considered before. So you game for this?
Let's do it.
You can't say no. The just would be awkward. We have 30 minutes of silence. So Adam, for those who might not have caught the first episode, just I know why I want you to help walk through this stuff with me. But give people a little bit of your background of where you've been and what you've done and how much time you've spent at this thing called the financial market game.
Yeah, sure. I was a finance major in college and was fortunate enough to help work on the endowment at Washington State University my senior year. So it really gave me some real insight into how institutional money is run, and was able to leverage that into some opportunities, and ultimately one great opportunity in Boston, where I spent 10 years at a large institutional firm called Wellington Management.
Which, for those of you who may not know, is one of, if not by some, considered the preeminent institutional money manager in the U.S. They sub-advise for the Hartford, household name. They sub-advise for Vanguard, which I think is not only impressive but also a little ironic, given what Vanguard, they're hiring active management for some of their funds while preaching about the fallacy of it to everyone else, or their opinion of such. But so yeah, big time shop. And what were you doing for Wellington?
Yeah, I spent most of my time on the global equity research side of the business. So my job was to take apart financial statements and look at companies kind of inside out, bottoms up, and really figure out what the intrinsic value of a company was relative to its public market price, if we could make money on it by putting it into our long-only portfolios or even in our hedge funds and profit on their decline. So spent a long time just interviewing management teams, learning about accounting and how to value a business, and it gave me some great insight into how companies are run and just how expectations are really used to help manage a portfolio, and how you find investments relative to those expectations to hopefully drive upside for client portfolios.
I know your opinion on this. I mean, well, and it's such an unfair question, so that's why I'm going to ask it. But active and passive, I mean, this is something, it's a bit of a misnomer, I think, really. And I know in knowing you obviously spent a bunch of your career on the active side of security selection. I know you still believe in it. I know you also, not only with what we've done here, but in past, have certainly used passive ETFs and are not, it isn't this mutually exclusive thing. The things can work together, right? But how do you think through, and I know you have some theories around just kind of why things have worked as long as they've worked in terms of the passive bent of investing, given some of the different things going on within the markets in terms of dollars chasing limited amounts of stocks. But walk us through, having spent that much time on your career, how you think through where people want to seek out active management, Maybe it's on the security selection, maybe it's on portfolio design, the role you see in passive investing. How does somebody who's actually done it on a day-to-day basis? Because I'm, again, help people manage their wealth. I've never claimed to be a stock picker. You've done that. You've been at the highest level, there on the front line, so to speak. How do you think through that debate for so many of the people out there who they only know the talking points, but they don't necessarily know the details of everything that entails?
Sure. I mean, passive investment has always become a bigger part of the investment world for a long time, almost 50 years now. And it's gone through iterations of different types of portfolios where active has been added to passive, index plus funds, where certain asset classes were more suited for active and management. What we've seen in the last, especially 10 years, is really the combination of low interest rates and an entire generation that's never seen a bear market, this overwhelming influx of money into passive money, and it's really crowded out active investors.
Within singular asset class, really, almost, in U.S. stocks.
Yeah, U.S. equities, particularly large cap U.S. equities. And in a shrinking universe, right? I mean, the universe of publicly traded stocks in the U.S. has shrunk by half over the last 15 plus years, but the global landscape of investors has increased by many multiples of that. So you've got more investors out there investing in fewer assets, and this growing belief that passive management is the right way to do things. At some point, the tail kind of starts to wag the dog. So from a portfolio management perspective, it's important to realize where not only what you're invested in, but where you're getting your exposure, whether it's geographically by investing in international or emerging markets, by different asset classes, by different sizes of the market. No question that large cap U.S. investing overwhelmingly has been a passive game for quite some time now, especially in the last 10 years. So we look for opportunities to invest the most efficient way possible while also keeping client needs in mind, such as risk, downside risk, income growth, those types of things. But I think going to an advisor or a professional money management business allows you to have access to people that look beyond the obvious. The S&P 500 is one index of 500 stocks, in the U.S. There are 50,000 stocks globally, and when you add fixed income on that, a lot more places to put your money. So I think our role is not just about investing in stocks or finding the stock. It's really about balancing that side of the equation, where how do we efficiently add exposure to certain parts of the market where we don't necessarily add a lot of value on the active side, but where we can get exposure to places in the market that other firms or individuals don't necessarily look, whether it's growth-rated markets on the income side in Europe, or emerging markets, or different fixed income vehicles, or real estate, or different types of trust structures. So it's really, I think of it as anybody can go out and buy a lot of musical instruments, but you really have to have a conductor to put them in order and find the people to play in order to make them kind of sound like music.
Mm-hmm. I think for a lot of people who, it's just intimidating, right? There's plenty of people in the middle who say, hey, I want to be conversant at this, but I also respect what those who are committed to the craft bring to the table in terms of financial guidance. You have people who have a lot more confidence they should on a frighteningly small amount of information that they think they know. And then you have people who are just totally intimidated. I think for me, when I think of the active passive debate, I think it's important, but it gets pretty wonky pretty fast in terms of the nuances between asset classes and where it's more appropriate or less appropriate. The thing I come back to, and for those of you who can listen, what we hope to unpack today is, again, to show you some angles on the market that you may not have seen, as well as leave you with maybe some concepts to stew on to help make you a better investor. But one of them for me, and we did a 4-part series in our commentary a year ago, almost exactly. What is this here for? And I think that's a great question to start with. And the unfortunate answer for so many clients is like, well, I want to make money. Okay, great. Over what time frame, right? Because one of my favorite stats is, roughly half of trading days are negative, about a third of months are negative, and about a quarter of years are negative. Just talking about the S&P 500, right? So if your idea is like, well, I bought this to make money, it's working if it makes money, there's going to be a whole lot of opportunities for you to short circuit that because it won't have made money. And that dichotomy is what leads so many individual investors, again, to have averaged that 2 to 3% that you see show up in studies versus the 10 that the stock market would give them, is they hit that panic button during tough times and don't realize that, again, the market doesn't work every day, but it will work over time, and you need to give it that kind of space. But more importantly than that is, if you bought a bond, let's just say, and you bought a stock, you should have bought those for very different reasons. Yeah, you hope they both go up in value or pay you some money over time, but how they're supposed to act or behave, it has to go deeper than that. And that's the thing I think that's lacking for not just so many investors. I mean, I don't know how many advisors I hear talk about things like that, right? They just buy a bunch of stuff to have bought a bunch of stuff, or they grab something off the shelf to have grabbed something off the shelf. But you're like, but why is that one here? Like, tell me about that fund or that stock or that real estate position. Like, why did you put that thing in, and what should my expectations for that be in? Again, not with respect to the S&P 500, but just period. Like, why is it here? What's it supposed to do? How would we know when to leave it or take it out? Is a question that again, a lot of people worried about politics, a lot of people worried about the North Korean peninsula, a lot of people worried about active versus passive, a lot of people worried about fees, not enough worrying about knowing why you actually own what you own, which at the end of the day, purely from an investment perspective, is the most important thing that you need to know. And 20 plus years in this, it's the thing that people know the least about. They'll tell you what's going on in the political front, but you ask them, do you know how your account's allocated? And almost inevitably, they don't accurately have a concept of what they're actually doing.
Yeah, I mean, I think in markets like this especially, there's when complacency is brought to its peak, and expectations are so elevated so high that people have, as you say, worry about different aspects of the market, but it's at the water's edge, right? They don't really actually take action, and they don't practice necessarily risk management or have someone that helps them understand why an individual position is added. It's in these types of markets, risk becomes less important to people than return. And I think from a contrarian perspective, some of the most successful investors in the world are ones that look at the landscape and say, hey, look, everybody's focused very much on this thing. I'm going to focus on the opposite. Mm-hmm. Because that's how successful investors become more successful investors, is by being brave enough to look at the landscape and looking where others aren't. For example, we've sat here and said S&P 500 several times. The U.S. there's no question the U.S. has been the place to put money for the last 10 years. People throw around the phrase cleanest dirty shirt because the U.S. continues to grow. The low interest rate environment has really worked for that growth. But, companies in the U.S. are incredibly levered, and valuations in Europe are, half that of, say, the U.S. From a multiples perspective. There's tremendous income there. And while I'm not advocating everyone should put their money in Europe, what I'm saying is there's a tremendous amount of value being overlooked simply because people don't necessarily act in a contrarian manner to take a look at that and realize that there's value there. Tim and I were talking before we started recording this about Michael Burry, who you all know from the movie The Big Short. He's the one who kind of figured out that there was a subprime market that was ready to implode back in 2008. And he came out in the last couple of weeks and said there's small cap companies in Europe and Asia that people just are overlooking. And it's been so easy just to put your money in U.S. markets and just put it on cruise control that it does create some inefficiency in the market. And it takes guys like him to start investing there, and for other people to say, maybe I should, and pretty soon that can form a trend and things can start going in the direction. So I guess to summarize, I think as professionals, we try to focus on the things that aren't obvious, and we try to ask ourselves questions and challenge ourselves to ask better questions so that we can run money in a better manner and not overlook the things that are not obvious, right? We want to find value and protect investor capital as much as possible in places that aren't necessarily conventional.
Yeah. Going through, and I did a commentary, I'd flesh it out maybe a little bit more here within this podcast form than a 5-minute video like I was forced to do it last time. But coming back to, question number one, which is, do you know what's in your portfolio and why? I think another important question for people to ask, they know the right answer, but to really ask for themselves what they believe and then how that actually needs to manifest is, are you an investor or are you a trader? And what I mean by that, specifically when it comes to the trading part, is do you really believe you can time the markets or do you not believe you can time the markets? And again, they're always pleasant conversations and not necessarily even most of the time with clients, but where people are like, man, I feel like market's due for a pullback, right? I feel like it's going to crash any day now. Or what are we going to do now? You have a couple bad days in the market, and we'll even get some client call like, hey, should we get out? And like, are you going to time the markets or are you not going to time the markets? Like, I'm not saying we should time the markets. I'm just saying, and this is where you got to be careful about things that, again, no disrespect intended toward anyone, sound smart, but actually are a little bit more problematic than at first blush, where they'll say like, well, don't you think we should get out of the markets before they go down? Yes. Problem is, how do we know this is the time that it goes down? And again, throwing out a rough stat for people. It works in a very linear type fashion, but it's like 80% of 5% pullbacks never become 10. And like 80% of the 10% pullbacks never become 20. My point is when people are like, well, I knew the last time it did this is another common phrase we'll hear. It went down even more. You're like, no, the last time you remember it going down, it did. But very few pullbacks become deeper at whatever level they are. It just, the funnel gets narrower and narrower and narrower. And yet it's another one of those anecdotal feeling things that, again, Daniel Kahneman wrote about at length in Thinking Fast and Slow, which is we think we're good with numbers in our head. All of us, this goes for you and I too, and remembering things, but emotions and time and history contort how accurate a lot of those things are. And so for me, it's something I know, particularly over the last couple of years with things being as volatile as they are, is like, we can't time markets. Like, no, I know, but we can't think about it. And you've slowly seen, none of them really wanted to try to do that. They kind of got that they didn't want to be a quote unquote trader, but all these subconscious kind of sayings or feelings that they had that really had to be called out to light for them to understand some of the unconstructive tendencies and thoughts that maybe they had as an investor that, again, great people didn't want to do it. Rational thought, yeah, you should get out of markets before they go down, but understanding how you're going to get out, how you're going to get back in, is this really going to be the big one? Is something that few, if any, people have really been able to, there are the Michael Burrys who get their one shot at really figuring that thing out, but nobody's really made a habit out of being able to time market moves. And I wouldn't even say his was a market timing move so much as it was, he just saw a singular structural problem and got out. Anyway, thoughts on that, investing versus trading and all the subconscious things that weigh on our psyches?
Well, I don't think you learn who good investors are in a bull market. I mean, Michael Burry is a great example. Nobody knew he was a good investor until the bottom fell out, and he actually profited from that position. The whole time the market was going up, and even while it was going down a little bit, there was a lot of people that thought he was crazy. So you usually don't find out who a good investor is until markets decline. So,
and what I think is really a testament to him, and again, this admittedly is still in the land of anecdotal because I know what little I know of him from around CDOs, and then now CDOs, excuse me, and now with his call here. But to his credit, at least it's something different. Because usually when someone makes a big bearish call, they just become a bear, right? He went from, I'm going to short subprime U.S. mortgages to, I'm intrigued now by some international small cap opportunities on the long side. You don't see that too many. I mean, when I read that article the other day, I'm like, that's different. I mean, Nouriel Roubini came out and supposedly called the '08 crash, and he just kept calling crashes until he became irrelevant. And people were like, well, you don't know how to sing any other songs. Michael Burry at least went to the other end of the spectrum in a lot of respects, going long international small value as opposed to short something. And that to me got my attention and gained a little bit more respect. Not that he needs my opinion, of the fact that he can at least, look at things with fresh eyes.
And he subsequently got bullish at the bottom, right? That's when he got excited about buying stuff, and people thought he was nuts because people were losing everything. But I tell people this is the only industry where the product goes on sale and nobody wants to buy.
Yeah.
So I think being a successful investor, to your point, has a lot less to do with timing and more about trying to suppress as much emotion as possible and looking at the facts, which is sometimes there are better bargains than other times, but you can't just hope against hope that the market's going to continually rise, because this market will at some point stop moving up. And, even this year we've gone, first couple months of the year were the strongest part of the year. We've gone sideways ever since. A lot of the catalysts that existed to get us here, tax reform, other legislation, and even a Republican administration, a lot of those things have kind of worked their way through the system. And now we're really trying to look for earnings growth more on something more organic, which is tough to come by.
A lot of things aren't in a bull market, right? I mean, you can even the U.S. market year over year, as of like a week or two ago, is perfectly flat. I mean, it was literally like 0.6 points on the S&P 500. It's low single digits annualized rate of return since late 2017. I mean, we've kind of been stuck in this range-bound market for a while right now, but you still have the Russell 2000. So these are mid and small U.S. cap stocks, everyone down, roughly 10% from their highs last October. Again, I think it's this weird thing. My thesis is that without the boom bust periods that we've seen in the past in terms of the private side of, kind of credit to income ratios, whether that's credit card on the public side or now corporate, corporate debt as a whole side, but balance sheets still look on the whole relatively healthy. But then maybe this is the new recession, that we kind of grind things through, kind of flatline for a while. We saw it from 14 to 16. We've kind of been seeing it again for the last 2 years. I question with interest rates where they're at right now, we may not get great growth, but will we get? There will be a recession again. Don't misunderstand me, but it doesn't strike me as abnormal given these conditions that this economic cycle is lasting longer, because it's just been so much more tepid, I guess. And you've seen these kind of stall speed things for a few times where before it was like straight up, straight down, straight up, straight down. This one's been pretty gradual, flat line, gradual ascent, flat line. And it makes me think that that might help extend the cycle quite a bit further than it's been in the past. But
and if you think about the last 10 years, even though we've been in a bull market, what's interesting about what we've seen is that we seem to experience, instead of a 9-month bull market followed by a 6-month bear market like we experienced historically, we see these long progressive rises in the market followed by these quick dramatic drops that quickly recover. And I think that's more consistent to what we'll see in the future. I don't think we're going to see the same level of cycles that we saw in the past necessarily. And it's part of the reason is the way the market is now. We have a very, very large investor base across the globe hungry for assets. I mean, so much so that we're trying to find new ways to expose ourselves to get exposure to new assets or assets that have previously become private. There are more funds today that have private allocations than ever. Even accessing private markets more easily for conventional investors is something a lot of people are pursuing right now, because there's a lot of businesses that don't trade publicly. So I think there's a lot of people looking to put capital to work, and that does help support markets, especially in a passively driven market where we're told that if you put money in this pile, it'll grow over time. So I think that is definitely working towards supporting asset prices outside of anything happening on the economic side.
I think the other thing I'd remind, to finish your point, I think how we think through economic cycles needs to be rethought. And I'm not trying to rewrite some economic textbook, but I think we both kind of said the same. It's just going to look different. We're still using these very generic definitions to try to create these, this is a bull market, this is a bear market. You got to have 2 negative quarters for a recession. And it's like things could just look different, right? Whether that's quicker, declines followed by more gradual ascents, more stall speed, low level growth as opposed to 3%, negative 3% type boom bust, GDP numbers. I don't know. I don't want to, in the vein of keeping a Michael Burry type perspective of thinking outside the box, I just getting stuck into these, there's just so many new facets of what's going on right now, particularly around federal banks' involvement, that I just think using all the old factors you might miss something. That's been my thesis for a while. I think the other thing I wanted to make sure and get your thoughts on, when you obviously had your time at Wellington and then you ran your own long short fund. Huge believer, as I know you are, that's why we're working together now, in partners, of holding people accountable. I think that's probably the most dangerous thing that goes unspoken about as an investor. It is an emotional game. Egos can't help but get caught up in it. Your dreams are caught up in how you want to finance things. You've got clients, if you're on our side, but even let's just talk for those who may be listening, who aren't financial advisors out there, which I think is most. How do you keep yourself accountable? I think is the question I would encourage people to ask. I know for us, if I push a button on a trade, I got to go answer to all. Well, you and I have talked about it at length, or you hit the button on the trade. We've talked about it. We got to go talk about it with all of our colleagues. We're going to have to answer phone calls from 700 clients, potentially. Everyone's going to know. Nothing's done in secret. Where I happen to know, these are not clients of countless people who liquidated all of their portfolios before the election because they thought Hillary was going to win, liquidated all of their portfolios after the election because Trump did win, right? So this isn't a right or left thing. And all of them missed out on a ton of money, right? But other than maybe sharing, the news over a happy hour drink, they don't really talk about it a whole lot, and so it gets buried, right? And these are where the studies, because what you hear at the cocktail parties is about everybody's successes and all the great smart things they did. And with very few people do they share their big colossal blunders that have actually cost them out on a lot of money. And, you missed out on the first month or two after the post-election rally with your equity exposure. It's going to take you years and some really fantastic calls you probably won't make to catch up. So point being there is, if you don't have an advisor you can trust, probably having somebody in your life that isn't just going to be like, oh, it's okay, buddy, but really will challenge your process of how you came to that decision. Obviously, this is the role I think we can play for a lot of other people, or any other advisor really has a best practice. But to you, Adam, how did you particularly, both when you were at Wellington and then when you were quote unquote on your own there for a while running your own fund, how did you hold yourself accountable to make sure you were being honest to a process as opposed to making emotionally driven decisions?
Well, I learned a very long time ago when it comes to this business and many other places in life, people don't buy numbers, they buy a process. So I try to maintain transparency with my clients, and you're going to I tell them before they even became clients, look, I'm going to make mistakes. My goal is to make as few of them as possible, but I think I have a process in place that is a long-term success strategy, because this is how I go about putting names in portfolio, and this is how I adhere to a thesis, and this is my buy discipline, this is my sell discipline. Clients like to know that there's, much like anything in life, they want to know there's a process involved. The people that tell us stories about their wins, people have luck all the time. And look, I'd rather be lucky than smart is the expression. But at the end of the day, when someone's managing your money, you want to know how they're doing it, because if someone doubles your money, but you don't know their process, you don't know if that could turn into zero the next day. And that's happened plenty of times. I mean, the crypto market has been a great example of that, where people, in the last few years have made and lost fortunes overnight because there was no process. It's purely speculative. So I think this business, the successful firms and the successful strategies that are around for the longest period of time are driven by a well thought out process that is exercised over and over and over again. And you try to leave out of motion as much as possible. It's hard to, right? I mean, nobody likes to have a company report their earnings the next day and it's down 30% and it's 10% of your portfolio. That's painful, but it happens. And tomorrow's another day, because you could have one that's up 20% or 50% or go through a buyout. So adhere to a process. And on the client side, if you don't have an advisor or you're looking for one, make sure when you sit down with whoever you're talking to about running your money, that they have a process, because a lot of times, especially when they use the word like I believe or I feel, or people that are motivated or at least driven or react based on in headlines, those aren't process-based people. That's more of a gut feel or a timing mechanism, and that may work in the short term, but it never works in the long term.
The other thing around ego, outside of making calls, I've seen, there's the ego of wanting to be right. I think the other thing that investors, there's a fine line between being patient, which certainly can take courage in the face of volatility, and thinking that, you have to have some Spartan approach to your investments in terms of these overly heroic acts. And I'm thinking of one gentleman we were talking about before this podcast started, who of course will remain nameless, but I mean, he just loved to tell you about what a man he was, right? And all the manly things he did and how he did this manly thing and did this scary thing. And for him, that meant keeping all of his money in like 2 or 3 stocks that he had made quite a bit of money on. And in his defense, blue chip stocks, oil stocks, they'll never go down. And he woke up after a short period of time to have lost half of his money, not a client, right? He was like, I don't need a process. I basically have, oil and my manliness on my side to getting there. And I'm not being overly harsh. This actually was one of the least pleasant people I've had the opportunity to sit down and have a conversation with. But the point is, all that aside, I felt bad for the guy, actually, that I'm like, so now here we are 5 years later from the time we've had that conversation. This is a few years back even. You've got to be getting about ready to retire, and you just imploded the better part of your net worth, And I think that's it for people is again, all these balances, that's where, again, whether it's an internal partner, an external partner, of having someone who can really hold you accountable. You and I have had some conversations that I don't think people would have thought we were fighting if they walked in, but they might have thought we were arguing, because we're like, well, I don't know, dude, I think that this could be this way, and really challenging each other's thesis to get closer to hopefully something that resembles the truth. But there are very few people who have that, and of course then whoever you have that, you hope is someone who is worthy of that role, not only in terms of their ability to keep you honest, but hopefully the insights that they can share. When you were at Wellington, how often would you all get together and share ideas and outlooks and review positions within whatever group you might be working with?
Yeah, daily. Wellington has a morning meeting where every investor in the firm sits around an amphitheater, a bunch of horseshoe-shaped desks, and for 30 minutes they talk about the world. And I think critical to any process, be it at a firm like Wellington or even this firm, is you have to have a collegial environment where people have respect for one another, but also an ability to react or at least act in an environment that has some intellectual tension. You don't want people coming together and just agreeing with each other, because that's not how ideas are resolved. That's not how new ideas are born. You need a process where people can challenge one another in a respectful way in order to drive things forward. And I think the combination of culture and curiosity in that kind of context really moves things forward. You asked me a minute ago how I held myself accountable in my fund, and I didn't have that opportunity to be in an environment that had people kind of challenge my ideas. And I think better ideas are born based on that. But also, I think doing your homework, right? I think if you were to ask anyone when they say they own a position, why do you own it?
Mm-hmm.
If it's because it's always worked,
mm-hmm.
I'm not sure that's the answer that justifies holding the position.
Yeah, as it was for that guy, my example a minute ago, yeah.
So I think it's important to know why you own something, because that is part of the process. And when you ask here, if you were to ask any of the advisors or any one of us why we hold something, I think we have an answer. We would have an answer for you that's based on a lot of thought and a lot of time and a lot of, going over the portfolio repeatedly and challenging ourselves to make sure we hold the optimal position. And we could tell you why we own that position. So to go back to your last question, I think being in an environment that allows you to ask questions of your colleagues to drive better answers is how good firms and how good processes are built.
We had that opportunity a couple weeks ago. You and I, one of our clients was like, I want to know why you own. Credit to him. And he was like, I'm not trying to be a pain. I'm like, I love it. Like, you want to know our process. And he wanted to know why we haven't had that happen too often, where someone actually subjected themselves to a 2-hour breakdown of every single position and why we held it. But it was cool. I think he enjoyed it, and you and I, like to share that work. Well, as we head out, we'll wrap up the podcast on this. Not so much a market call, but just what would what things are you paying attention to in the markets? What might investors be thinking about? Again, not to try to trade or market time. I think there's I raised this point, and I'll preface everything we're about to say with this. Someone asked me, why do you put this commentary out every week if we're not supposed to do anything with it? That's a good question. And what I told him was, I said, it's actually more for the emotional side of your investing than it is the financial. And what I mean by that is so that you won't be caught off guard, that there won't be a surprise, or that hopefully we can mitigate some of the bad news that's out there. The analogy I made was, if you're jumping into a lake that might be a little bit of cold, it's not going to be pleasant, but it's not going to be like earth-shattering shock. If you're sunbathing and someone throws ice water on you, that could literally even physically cause damage, right? And so a lot of the commentary, and I think being successful and being patient, is being knowledgeable. Now, for you and I, yes, that sometimes means trades, but not because it's necessarily a market call so much as an opportunity that we think's opened up. But for the average investor who's out there, just being informed so that you don't suddenly have the market do something or get a piece of economic data, get shocked by it, and freak out and make an emotional decision that can negatively impact your portfolio. That's why I try to share as much information as we do. Is I just think an informed person's less likely to make jumpy decisions as opposed to someone who's been pretty checked out, pops their head up to a piece of bad news, and suddenly feels like they've got to react. But does that make sense to you?
Yeah.
You can say no.
Yeah. No, I mean, I know. I think this is a lot like exercise. I think, first of all, we love doing this. This is what we do for a living. We think about this all the time. When we're here, when we're not here, when we're, on a treadmill. And I think this is a lot like exercise, and it's consistent, and you have to be consistent about the process and the strategy. I think there are topics and things happening in the world that make some of these conversations more relevant than others. But I think it's about a marathon, not a sprint. We're not going to do this once a year and every year make some dramatic sweeping comments. I think letting you know kind of what we're thinking, how we look at things, how we derive our process is an important part of this. And look, some people may listen to this every week and get very marginal information out of it. Some people may listen to these once a month, once a quarter, and might feel like it's helpful. But for us, it's just as much for us as it is for you, for us to externalize and verbalize these thoughts we have and talk to each other. From this conversation, we'll probably have 3 or 4 more conversations over the next week or two about thoughts that came up in this.
You'll probably call me
conversation.
tonight, actually, is what you mean by that.
So that's why I think we do this.
Yeah.
And in terms of what I look at right now in this market is, we live in a global community, more so now than we did a week ago, more so now than we did 10 years ago. And it's important when you invest in a global community to remember that things tend to move together now. It's not like stocks will go down in the U.S. and everywhere else in the world will be fine, right? I mean, Asia are big customers of the U.S. We are big customers of theirs. We all move together. So investing in a way that allows us to minimize any kind of volatility from downside, whether it be from political issues, whether it be from economic issues, is important. So I'm looking at the landscape and thinking about how we derive portfolio returns from cap gains to income. And Tim and I have talked a lot about this. We can talk about it at another point too, which is where are we getting return and what type of return are we getting? So that's what I'm focused on a lot these days.
Any headlines you want to comment on? Or was that your attempt to avoid commenting on 10 and 2 treasury yields or politics?
I think I'll just leave that teaser out there. We can talk about it more at another time.
So the commentary we're referencing, for those of you who don't know, maybe just know us because of this podcast, you can go to 10capital.com. That's TENCAPITAL.com and sign up. We put out both a written and video commentary every Friday. You can get that, no cost whatsoever to be a part of that. Yeah, I know. I think for me, I look forward to 2020 actually with a fair amount of optimism. I'm sure the back half of next year with the election will bring plenty of headlines, but a lot of the reason for my optimism, again, overarching things, is this thesis that we've been grinding through the last 2 years of pretty tough returns to no returns in a lot of asset classes, or even flat returns amongst the S&P, which is obviously the biggest, most followed asset class, is kind of a mini recession. Again, that's a thesis, and when I look at the state of the consumer, some certain things picking up in other parts, I think there's kind of these mini cycles within the cycle, and that we might be turning that around. So how I sleep at night with respect to my clients is a lot of you said, hey, we've got to get enough cash flow off these portfolios today, no matter what the market's done, to help them get through it. And I think that's critically important. I've got to pay attention enough that I'm not going to make an emotional side of it. You've got to think through it always, both from an emotion, how am I going to prep emotionally, and how am I going to be prepared financially, and have both of those issues. But as we come then into 2020, I actually see a lot of things that give me optimism. I'll also leave everyone with this, and I mean this with everything that I have, which is a lot of my confidence for things moving forward, and a lot of the way that I can explain why things continue to go pretty well despite some bleak things, is the perseverance of people. And I think it's a point that's lost, particularly these days where we're talking so much about politicians, we're talking about volatile markets. Markets are wonky. They're efficient in some respects, but they're weird in many others. Politicians are almost all weird. But every day, each of you, like us, gets up and works as hard as we possibly can for the betterment of ourselves and our family. And that's what makes the thing go round and round, is that, and I'm maybe in a unique position of being blessed to talk to so many professionals and business owners and people who are waking up every day with goals and ambitions and trying to do things, although I think it is something that's just not unique to someone who's a business owner, but in whatever they do, that they're bringing passion to it and they're working hard. And that is what, in time, despite all of the horrific things that have happened throughout the history of time, has propelled things further, is people don't quit. And they get up and they go at it the next day. And so for me, one of the things I hold to, no matter how tough things may be, whether it's economically market driven, is that faith that, most people want to find meaning in life. Most people want to put something good out into this world. And if you can keep that collective doing that, on the whole, it's going to move things forward despite, the handful of lost souls that are out there. So that's my optimistic end to podcast number 24. Thank you for joining me, despite your hatred for cameras. We'll see you soon, everybody.